Guys, hope you guys are doing well. This is Sipho Mackenzie-Gyani, CEO and founder of S.M.D Investments. This is the institute that is responsible for the successful trading of over 80 plus retail clients. And today is the day that I decided that it's best the company has its presence both YouTube, Instagram, including Facebook and Twitter as well. So we are on all social media platforms, and I thought it would be a great idea to do an introductory video to give you a clue as to what it is that we do. So apart from the fact that we give professional education to retail traders and to prevent them from losing money, because as it stands, 90% of retail traders lose money in the forex market, right? Or even worse than that, right? We trying to reduce that and to ensure that they make the right decisions and not necessarily trade the way that the huge institutes want them to trade, alongside with the inversion narrative that is being pushed out by the brokers and all of these people who are incentivized by taking from the retail trader, right? So not only do we do that, but we also are a signals provider. So we provide signals. If a person is not interested in the 1 month course, they can also purchase the signals on a monthly basis. So apart from those two things that we give, I also wanted this channel to be about weekly analysis, give weekly analysis so that people can understand the shape of the market, so that it can influence their decisions into trading in a much more clear direction with a better perspective. To also give valid tips that are going to be very, very helpful, especially going forward, especially trading. And this is what this video is actually about, right? So it leads us to this video, and this is the 5 most important things that each retail trader needs to know before getting into the charts to trade. Now, this isn't your cliche and regular top 10 tips on how to trade, or top 10 tips on how to be a successful trader, and things that usually deal with things that are external or outside of trading, like for instance trading psychology, in which of course it is very big. Don't get me wrong, it is very big, it is very important, but what traders really need is tools to apply when they actually open the laptop, when they're in front of the market, when they're in front of the charts. And this is what I really want to give, because in keeping these 5 steps that I'm about to give to you guys, it will save you money instantly, right? It will save you money instantly. It will close the tap on the losses, and then it will create a proper foundation for you to then go on and build your profits. And this is what the premise or the foundation of S.M.D Investments is. The first week, we build a platform for a client whereby they close all the taps that are basically leaking, and stop giving the broker so much money, because throughout the course of your trading, you'll probably give the broker so much money, it's unbelievable, right? So let us get to the very, very first step, that is basically trade based, right? For retail traders, the first most important thing to do is number 1, right? So this is tip number 1. Tip number 1: always ensure that you have more than one account, right? So when you open a live account, make sure that you spread your money across different accounts. This will also allow you to have different portfolios, because you see, the only effective way to make money in the forex market is having multiple portfolios. However, that becomes an impossibility if you're only having them on one account. Number 2 is that you as a trader, you have different emotions. Sometimes you have emotions of greed. Sometimes you have emotions of conservativeness. Sometimes you don't know what to do. You indecisive. You fidgety. Like, there's many emotions that you have, and the thing that really suffocates the live account and what causes traders to blow is that all of those emotions are being expressed onto that one account. So instead, rather have, let's say for instance, 3 accounts, right? On this account, it will be your scalping account, right? Every time you see profit, you'll just basically take. Or every time you see that you might be getting into a loss, you close your profits decisively, objectively, without any emotions attached, right? The second one will be more of a long-term account, where you let your trades run even further, longer, for maybe like a week or so, and you are patient with them. And this is usually an account that you enter with a very very small lot size, so that you may also evade the swap prices that the bank may charge you, and also the different changes. So for instance, when you go on to the next week, the spread, it becomes very volatile, and the spread becomes high and the market becomes very volatile. So it also helps you save money from that, because if you're getting in with a high lot size, then you might stop yourself out of the trade, right? So that this is going to be the account for that. And this account, it could be basically a hybrid account, right? An account where at times, yes, you might do that, or this could be an account that maybe mirrors one of the other two accounts, or it could be an account where maybe you have alternative ideas, or accounts where you only want to you want to try something that you are only 80% sure of, right? Because at times maybe on the other ones you'll be like, okay, I'm 100% sure of this, in which that in itself is a fallacy, because you can never be 100% sure about something, in which we'll get into that. But at least use this account to enter trades that you know they have value to them, you are just not sure about them, right? So having multiple accounts allows you that space to be able to choose, because the worst thing you can do as a trader is to see an opportunity but pass on it due to the fact that you already have running trades, right? And that pressure can only come from having one account, because if you have more than running trades here, more than maybe let's say 3 running trades on one account, and then you enter another one, and let's say all 4 of these trades are running at a negative, you might find yourself having a margin call. So it is very vital that you have 4 different accounts, 1 trade on each, and you can basically then see the gradual growth without putting too much pressure on just one account, right? So that's step number 1. Step number 2, let me just check it. All right. This was going to sound very cliche, but this is why this makes it onto this list as well. Step number 2, or tip number 2, is always use a small lot size, right? Now, why is it important to use a small lot size? Well, coming back to what I alluded to earlier on my first point, nobody in the market knows what the market is going to do. No one is aware of it, right? Nobody, whether it is a retail trader, a trader at Goldman Sachs, no one really knows. No one can foresee, no one has a crystal ball as to what the market is going to do. So all of us, both the highest professional traders and the most gullible retail traders, all of us, we have one thing in common, and that is we do not know what is going to happen in the markets. So if none of us actually know what's going on, what is it that actually separates us, right? What separates the profitable traders from the non-profitable traders? And this is simple. It all boils down to risk management, and this is where it comes down to the lot sizes, right? Because sometimes a lot of people might not be aware of risk management, and let's say you are a new trader, so you aren't aware on how to calculate the pips, the amount of pips that you're risking, or etc., or doing things according to what your ATR tells you, so the average true range. So according to that percentage, it then gives you an idea on what the volatility is. So let's say you have no idea about those things whatsoever. The best thing that can help you is to ensure that your lot sizes are as small as possible. Because with small lot sizes, at least what it allows you to do, it allows you to take long-term trades, it allows you to relax, and it allows you to do this thing called set it and forget it, right? When you set a trade and you are able to forget about it. The only thing that keeps you glued onto the laptop more than anything else is over leveraging, because you know that yes, should this go your direction, you will be very happy, you'll be elated. But should it not go your direction, you are in trouble and you're at a risk of wiping your entire account. So always ensure that your lot size is very small, because nobody knows what's going on in the market. Here's an example. Say for instance, you have a $100 account, right? And let's say you are a trader that does exactly what I'm talking about, and reduces their lot sizes to a very small lot sizes, and applies proper risk management. By proper risk management, I mean that your risk reward ratio should be it should never be equal, first and foremost. So it should always be, let's say for instance, 80% should cover your potential profit, and 20% should cover your your potential risk, right? So for instance, right, if you have $100 account, right, and then you place a trade, and say for instance your take profit is at 20 US dollars, and your stop loss is at 2 US dollars, right? And you take 10 trades, right? And on all 10 of those trades, you apply the same risk reward ratio, right? Where your take profit is at 20 US dollar and your stop loss is at 2 US dollars, right? And let's say out of these 10 trades, you lose 8 of them, right? You lose 8 of these trades, right? So how much is that? 2, 4, 6, 8, 10, 12, 14, 16, right? That's $16 down the drain. You've lost that, right? Even if you lose that, you were to lose that consecutively, right? And you only get 2 profits, right? That 2 profits equates to 40 US dollars, right? That it's over double the amount that you would have lost with the 8 trades. And that is the effectiveness of using small lot sizes, or what we call risk management. Risk management is so powerful to an extent that I once heard this other guy who is a professional trader say that, with the risk management, with proper risk management, you can even turn up to the market and not even have a thought on doing an analysis or anything. Just take a blind trade, whether it's a buy or sell. Take any buy or sell trade, right? Take that 10 times, or maybe throughout 10 different currency pairs. Just take any guess, any mini money mo, buy, any mini money mo, sell, and apply proper risk management. And I tell you this, you are guaranteed to make money. And it is quite true, because coming back to the premise of what I've just spoken about right now, if your risk management or your risk reward ratio is always at an adequate place, then those small percentages, let's say for instance 20% of the time, when you do make money, not only do you make money, but you also cover out all those losses. And that is important to always ensure and this is why it's always important to ensure that your lot sizes are always reduced and you are applying proper risk management skills. All right, so yeah, that is point number 2. Point number 3, this is my favorite, and this is one that ensures that you are sealing the tap of losses, and you are hindering the brokers from basically making any money off of you. And that is whenever you place a trade, right? So during a profitable trade, always drag your stop loss beyond the place where you've actually placed the trade. Here's an example. Say you've placed a sell trade, right? You've placed a sell trade and the market gets into profit slightly. Let's say $5 worth of profit. You see, once you find yourself in $5 worth of profit and above, it is a cardinal sin to find yourself losing that trade after being in a $5 profit. Because what it is that you should do, you should drag your stop loss. You can either put it exactly at the same point where you've actually bought, where you've actually sold, or just slightly below, so that you can make 0.50 US dollars. Yes, it's not even a full dollar, but it's actually something. What this helps with, number one, is that once your stop loss and your take profit, once both of them are guaranteed to give you profits, you will then be able to set trades and forget about them and let them run their full course. Because you see, what we are as traders, as humans rather, it is in our nature to be very intolerant on winning trades and be very tolerant on losing trades. And that is a bad trait. Why are we tolerant? Because we have hope. And one thing about hope in trading, hope is for the hopeless. There's nothing such as hope in trading. It's either you are right or you are wrong, right? Just a sidetrack for a moment. I once even saw a video of some other trader. He's also a prophet, and he was literally telling his people that no, he'd actually prophesied that the trade was going to go this direction. That's good for him, right? But because you and I are not prophets, it is best to always stick to these principles to ensure that we do not give any money to the broker. So this principle of always dragging your stop loss beyond the place where you bought or sold, even in profits as minuscule as maybe $5, not in when you're in profit of maybe $2 or $1, that is too tight. It's gonna stop you out either way. But maybe let's say $5, $8, And as the market goes down, that's where you'd probably put it at, right? And what that helps with is that when the market, on this scenario that we've used, we've said it's a sell, right? When the market goes down and then it returns up again, if it knocks your stop loss at a profit of 0.50, right? Chances are the market doesn't just retrace where you've actually placed your stop loss or you've actually placed your initial trade. Chances are the market will rise even further above, right? And that then gives you another opportunity, a better opportunity to have a better entry if you are still interested in the trade, or if the trade is still within the auspices of the strategy that you've formulated, right? And then once that happens, you are able to enter at a better position. But having entered at a better position, you've also made 0.50. Then you enter there, the market drops down, and as it drops down, you move your stop loss beneath where you've bought, so that you are in a profit. So that best case scenario, you make your TP. Worst case scenario, you still make a profit, but very minuscule. By you doing that, you can now transition from giving the broker money to closing the tap. And then once you also implement proper strategies while having the tap sealed, you now transition into inflicting damage onto the broker, because that's the most important thing, right? The most important thing is you have to get to a point where you are now inflicting punishment on the broker, where on every trade you are basically being profitable. And even on the trades in which you get wrong, by just using these principles, because it could happen that it might go your direction and then it might go all the way back up. But even in that instance, in that scenario, you should still be able to milk the market as small and as minuscule as possible, right? So that is your step number 3. Always do a manual trailing stop, right? It has to be manual, because only you can assess if, all right, the gap is either too tight or it is safe enough for me to draw it down there. So here at S.M.D Investments, it is a cardinal sin to go from a profit into a loss. That can never happen. It's not allowed, right? And it also helps you build your account even more. Yes, I know at times it is going to be very frustrating because the market might bounce there 2 times, but once you have it in there and the market goes all the way down, you never have to check your market again, because the market will keep going down. And another thing to then maximize your profits, because this also helps with maximizing your profits, is you can also follow it down. So when the market is close, when the price is close to where your take profit was, your initial take profit, you can move your take profit all the way down and then put your stop loss just a small gap above, so that when the market then drops, so the market has either 2 places, right? So let's say if your take profit in this case is $20, right? And the market is at $18, right? If the market is at $18, you put your stop loss at maybe $16 and drag your take profit all the way down to maybe $30. And then what can happen is that either the market will bounce up, which is the worst case scenario, but you still make 16 out of a possible 20, which is the majority, or best case scenario, it will go all the way down, and instead of now making the $20, you make the full 30 from just doing a manual trailing stop of your stop loss, right? So that is step number 3. Step number 4. All right, 4 and 5, they're very quick, but they're very important, right? So step 4 has 2 things. All right, step 4 is always assess the volatility, right? There's 2 ways in which you can assess the volatility, right? Number 1, of course, is through investing.com, where you basically have the economic calendar, where you can check the times in which the news are going to be their most volatile. You see, you can't enter into the market, especially if you're a technicals trader, you can't enter into the market without knowing that, all right, in just a couple of minutes time, there's fundamentals happening, and you just enter in with a huge lot size, and all of a sudden the spread changes, the pace, the volatility changes, and you find yourself struggling or in a loss, right? So you should always know that, okay, if I'm going to trade on a Monday, Monday at 2 o'clock, there's a fundamentals that is happening right there. So either I trade after those news so that I can have a free gap into basically trading the things that I want to trade, or I can do my trading before that, or I can ensure that I can basically pull out before that happens, right? It is very important to check when the big news are going to happen so that you can stay away from them. You don't have to be too away from them, really. 30 minutes apart is enough, right? 30 minutes apart, because the news are going to react the way they do, but it will always come back to an equilibrium. And usually it comes back to the normal area in which it was initially, right? So that is also another thing to keep in mind, right? So always check the volatility, and also always make sure that you do not place trades on a Friday evening when it's close to midnight, or early Monday morning at like past 12 at midnight. Do not take any trades in those two midnight areas, close to Friday midnight and after Monday midnight, Sunday midnight, which brings you into Monday. The reason being is for the very same thing I've highlighted: volatility and the spread, right? The banks, the markets, their spread, when the markets reopen, they become very high. Likewise, right before the market closes, the spread becomes very high. So the worst thing you would want is buying or placing a trade and you are already negative $40 in a loss, and you first have to make that up before you can even profit a cent, right? And that's what high spreads can do to you. So ensure that that is sorted out, and you should be fine, right? Our last point: correlation. Correlation, this is very vital, especially when we're dealing with the US dollar, because the US dollar, the way in which you can check how it is going to move is to always check the US index, right? Because the US index gives you a scope on how the dollar is going to move. So if the US index is sideways, right? Only when the US index is sideways, it's ranging. That is when you can then trade dollar pairs. You can trade them independently. You do not have to rely on correlation. But when the US index, let's say it's going up, chances are that all the dollar pairs are going to gain strength over all the other currency pairs that they are paired with. And this is where correlation comes in. So the most traded pair, right? Euro USD, right? Euro USD. And then let's take also the US dollar to the Japanese yen, right? Now, if you are buying the Euro USD, right? If you are buying the Euro USD, you can't also buy the USD to the Japanese yen, especially when the correlation, when the US index is telling you the direction of the US dollar. Why is that? Well, when you buy the Euro USD, you are basically claiming or stating that you are predicting rather that the euro is going to rise against the US dollar. That's what Euro USD is. So when you buy, it means that you're buying the euro against the US dollar. So if you've done that, right, then if you then buy the US dollar to the Japanese yen, USD JPY, you are also then saying that in actual fact the dollar is going to rise against the Japanese yen. But what's the problem there? Just now on the Euro USD, you've just betted against the dollar dropping against the euro, right? When you are buying the Euro USD, when you're buying the euro, you're technically selling the US dollar, or you're basically predicting that the dollar in itself is going to go down compared to the euro, right? So if on one trade you're predicting that the dollar is going to go down, and on the next one, US dollar to the Japanese yen, you're predicting that the dollar is going to go up, that is a contradiction there. And as much as there's an opportunity you might get one right, you definitely will get the other one wrong. And knowing the market, you might as well get both of them wrong, right? Because not going for correlation or not taking notice of correlation is something that could really disturb your trading, and it will give you unwanted results or a mixture of results. So the best thing, always check the index of that pair so that you can see how it is going to go, especially with the dollar ones, right? I'm not quite sure about how the other ones, but the reason why I'm telling you this about the dollar is that I know personally that this is how the dollar moves. It moves according to what the index is, regardless of what the dollar is paired with. It is going to respect the dollar's strength according to the index, or the dollar's weakness according to the index. Right? So yeah, guys, those are your 5 tips, in trading tips. Bear in mind, there's many other things like trading psychology and all of the other things that can influence trading. But the ones that I've just dealt with right now are in trading, in front of the laptop, in front of the chart. If you keep these 5 things, your trading will instantly improve. Improve in a sense that you won't be leaking money as you would normally, or as you normally would. So yeah, guys, I hope that that was quite helpful. And as always, if you have any questions, whether you're viewing this video on, okay, I think the best place you can view it is YouTube, and maybe on IGTV, or maybe Facebook Watch. Wherever you are viewing this video, I want you to comment down if you have any questions. And yeah, I'll get to that. Or if you maybe wanted to add a point, feel free to do so. And yeah, I'm looking forward to basically getting your guys' reactions. But I hope this was quite helpful, and I hope you guys have a very, very splendid trading week ahead. Cheers.